I recently created a post on Reddit that got quite a lot of attention. I asked different communities of traders whether they had actually traded through the 2000 dot-com crash or the 2008 financial crisis. Now, I personally wasn't trading during these periods, and I would imagine most of us who are under the age of 40 years would not have been trading either. So I thought it was a good idea to get some advice from those that have actively traded through these turbulent times. In this video, I'm going to extract the best comments from various traders and give you my thoughts regarding their comments. Stick around because there's a lot of trading gems coming up. So in my Reddit post, I wrote, right now there's a lot of fear mongering going on. Some people are predicting a recession worse than that of the 2000 dot-com crash and 2008 financial crisis. Maybe, maybe not. Macroeconomics isn't my forte. Technical analysis is my focus. Looking back at the charts during these periods, the decline was severe and lasted years. I only started trading post 2020, and even though I traded through the bear market of 2022, it wasn't as severe as the aforementioned, though it was still a long and slow year-long decline, and I wasn't yet profitable too. So I'm curious about how many of you have actually traded through these financial crises and what was it like? What were the strong sectors and stocks during this period? What setups worked well and how was your overall performance? I hope we don't get a long and drawn out bear market, but I believe we should all be prepared for it. So any tips by seasoned traders would be appreciated. There were a few other questions I wanted to ask, but for the sake of keeping it brief, I left it at that. So let's move on to the best comments. I blurred out all usernames to maintain each user's privacy. So here is the first comment. Just when you thought things got cheap, they dropped again, and again, a lot cheaper. You couldn't make money in trading because you were just caught in the churn. You couldn't short because they blocked shorts on banks and there was no inventory. The volume premiums on options was too high, so you'd end up breaking even at best. Bank of America is a good one to look at. See it fall off a cliff and then keep falling, bounce and fall again. This isn't days of falling, it's years. It's interesting to hear that shorting was just as hard as going long, because you'd think it would be easier given the downward momentum. You often hear stories about how some traders make millions by shorting a particular stock or the market, but we don't really know how many times they got stopped out, where they entered and how long their positions were in the red for until they finally turned around. And we also don't really hear about all the money that has been or was lost by people trying to short the market. I'd imagine the amount of losers is a lot higher than the amount of winners. Anyway, let's take a look at the Bank of America chart. It began its decline in October 2007 and bottomed in February 2009, losing 95% of its value. It had a few bounces along the way, but after a few weeks to months, it went on to make new lows. It was absolutely brutal for investors holding on to this one, especially if they dollar cost averaged into it. Okay, so let's move on to the next comment. I traded in both the 2000 and 2008 crashes. What is going on now is nothing. In both the previous crashes, there was almost zero liquidity in tech stocks in 2000 and financials in 2008. Many stocks were down 90% from their highs. Many would drop 25% in a day. The only strong stock I remember from 2008 was MCD, McDonald's. Fortunately, there is still liquidity in tech and financial stocks for now, indicating that there are still plenty of buyers and sellers around. However, I have noticed that there isn't as much liquidity as before the recent drop a few weeks ago. Spreads are wider and volume is lower in many stocks. It's still early days, but there have been a lot of overextended stocks that peaked a few months ago and are now giving back most of their gains. Without a doubt, many of these names will take years to recover, if ever. Looking back at the McDonald's chart during the financial crisis period, it held up really well. Even though it did have some notable declines, they were no more than 30% or so. The stock just mainly went sideways and it couldn't really sustain any long uptrend. I think it would have been hard to swing trade this. Anyway, let's move on to the next comment. In 2008, Loan Desk didn't answer their phones or emails or messages. Used MIRC, AIM, BBM back in the day. I was at a long short fund originating and shepherding the short deals. I couldn't close out short sometimes as a prime broker we dealt with on clearings, Bear Stearns and Pershing later, DJI had systems that were breaking down. We couldn't get quotes for CDS. We bought to fill trades via market. It did work out because markets kept melting down. My shorts and hedges were more and more in the money, but it was a surreal feeling watching all those profits get nationally booked. But at the same time wondering if there was a financial system that would survive. I took my bonus, liquidated my RE holdings, went cash, waited a year and bought insanely high dividend yielding high cash flow survivors and retired from finance. Did not miss the stress. Others have spoken to it. I started in .com, survived that, then the telco boom. This market is different. It's not even close to the debacle of 2008 yet. However, even in the darkest hours, there was a sense that we, long, short, douchey IBs, even those GS cocksuckers, were pulling together for mutual survival. So were the Brits, the Euros, etc. And despite my personal misgivings about the moral hazard of bailing out MS, GS and others and rewarding their taking on risk, at least there was a sense of a strong, if overwhelmed, hand at the tiller that had good intentions. So that's an interesting story of a trader who, by the sounds of it, thrived during and after this period. Also, as I suspected, this recent drop is nowhere near the severity of 2000 and 2008. Moving on. In 2000, growth stocks had gone to the moon. The Fed juiced liquidity because of Y2K fear and raised rates as a tech bubble grew. Stock leaders were CSCO, it still has not seen its $65 price high since, and things like Netscape, Global Crossing and Lucent. Investors went ape for the internet, servers and fiber optics manufacturers. I think leading tech stock PE valuations then were twice or more what they are now for mega cap tech. When the Nasdaq bubble burst, it happened fast. Everything flipped initially. Defensive stocks like utilities, staples, healthcare and even financials began outperforming in a big way after underperforming in 98 and 99. The Nasdaq Composite declined 86% from peak to trail over more than 2 years, 2000 to 2002. The S&P fell about 50% over that time and did the same in 07-09. In the first bear market of what became a lost decade for many equity investors. Eventually, the defensives and financials sold off too, but nowhere near as bad as a tech bust. In 07-08, specialty financials had a big run. Countrywide Financial and other operations made tons of no-doc mortgage loans. Real estate prices started topping in 06. FL had gone bonkers for years. Then the rest of the country RE topped in 07, and then the whole economy rolled over as a higher Fed funds rate slowed the housing economy. Consumers had been putting nothing down on mortgage loans for years, using ARM mortgages to get the lowest rates or refinancing and cashing out their equity in the homes for spending. When RE prices finally cooled and started lower after a long rise, many homeowners saw their home equity vanish and realized in 2009 that they owed more in their increased mortgage or mortgage plus HELOC than the home was worth. Many consumers walked away from those mortgages and banks were stuck with bank-owned real estate in size, including all the acquired and developed home lots the home builders had bought up and then returned back to the banks. In 2007, not surprisingly, consumer, financial and real estate sectors led the downside move. Energy, materials, staples, utilities held up well. In 2008, most everything got clobbered. Staples and healthcare sectors led the market at -15 and -22% respectively. In 2009, the stock market bottomed on aggressive Fed cuts and liquidity moves. Tech, materials and consumer sectors actually led the stock market that year. Fun anecdote. I remember playing trading options in the spring of 2008. I was on a desk, the weakness in the real estate was evident and I figured consumers were toast. I bought put options with maybe 1 or 2 months till expiration on American Home Mortgage, AHM. I was a young grasshopper then and learned an early lesson. I was right in my directional view, but the put options expired worthless. The stock didn't fall apart until 2 months later. Really interesting to read with a lot to unpack. I think the main takeaway from this is that during these periods of massive decline, practically everything fell victim to the downward pressure of the market. Even strong sectors were in decline. Now this doesn't fare well for investors and long-based swing traders. So in this scenario, it's probably best to sit in cash or put the money elsewhere. Somewhere that will yield a relatively good return and wait for the market to bottom. Try not to get wiped out because when it all cools over, there's going to be so many opportunities, but you'll need a lot of cash for it. Next one. I traded through 2008 and forward. If you want to know what it was like, nothing like right now. This present market is actually very strong by comparison. When the first banks began to collapse, it was a genuine crisis. People were losing their homes left and right. I still have 2 homes I bought at a deep discount in this period. Truly, all the talk you hear right now of this present market collapsing is nothing more than children wetting their pants. And there's a direct reply to this comment which says, perfect way to describe it. I started investing back in the late 80s. Yeah, 2008 was scary. Even the talking heads on TV were saying to sell everything after the market was already down 15 to 20%. They were right. For an unrelated reason, I moved our 401ks to all cash in September 2007. Best, luckiest move I ever made. Moved back in at about 7,000 when it was pretty clear we were going up. I did do some trading. Recall trading Motorola and Wells Fargo about 5 to 6 times each, selling whenever I was up 10%. Kind of fun actually to do some homework. By comparison, today is like you said, but the media and social media posters have to always find something to keep the hysteria and conspiracy theories going. Well, I completely agree that the media loves to invoke fear because fear sells and it drives a narrative they want. Now in our current circumstances, it's probably a mix of fear and reality. I do believe that the level of fear isn't at its peak yet. I mean, it would take some sort of black swan event to trigger mass panic. Moving on. I say this with a grain of salt, but some stupid tariffs aren't going to be anything like a countrywide housing bubble crash due to subprime lending. That being said, we may definitely be sideways to down or up if we're lucky, but I think some of the old faithful rules apply. Trade consumer staples or risk-averse assets. Maybe sell calls of a long portfolio if you have the capability. I wouldn't be putting a bunch of money into moonshots right now. Crypto I think is okay if it's a popular coin at a decent price, but definitely underweight if you want to be smart. I'm personally pretty risk averse these days, so I'm trading more with the long game in mind now, and especially given the current economy, basically buying and holding, expecting a rise, recovery in the next few months to a year plus. I will also be DCAing into some crypto and Nvidia in the next few months and playing Meta and Nvidia monthly to 2-month calls when opportunity arises, not financial advice. As a trader, I think there's less trading opportunities in defensive stocks. They certainly can make long and sustained moves, but nothing like growth stocks. They're much more suited to mid-long term investments. And That's what you may have to settle for in a bad market environment. Also, I personally think it's too risky to DCA into individual stocks because you don't really know how bad this market could get. However, I am dollar cost averaging into QQQ and holding it for the long run. Next comment. The investing and economic landscape was entirely different at the time. The iPhone had been out for 1 year. BlackBerry was a company going to the moon. Motorola made a Razr flip phone that had a battery which lasted 2 weeks. Microsoft was in the doldrums. Amazon was nowhere near the company it is today. Nvidia made gaming graphics cards that crashed all the time because the drivers were shit. Energy stocks made up the massive percentage of the S&P 500 versus tech today. We were in a housing oversupply situation that seems like a fever dream today. There were so many houses that were occupied by renters who hadn't paid rent in months, and no one did anything because the owners were in foreclosure. In fact, today's housing affordability supply crisis is a direct result of the fundamental overbuilding that happened in the early 2000s. You can't compare then to now. Our economy is underpinned by very different risks and opportunities. I'm not really well educated in the housing situation. All I know is that the property situation in almost every major city and town worldwide is in dire straits. Whether this is all by design, greed, or negligence is up for debate. Next one. I nearly wiped out half my pension because I was short agriculture in an ETC. Trading was suspended because the collateral was supplied by AIG. Thankfully, trading was restored when they got bailed out. I sold for a big loss. Ironically, being short AG was an amazing trade to be in, and if I had held it, I would have made big money. I also remember there was a day when pretty much all my broker alerts got triggered, even the "it will never go that low" ones. Worst decision ever. I used to read Carl Deniger's blog and he said to dump everything in early 09. That was actually the bottom, so please don't follow financial experts. Man, it must be so scary watching your pension slowly eroding away, especially if you're nearing retirement age. And regarding the AG short trade, half the time when you get stopped out, the stock will eventually reverse and you would have made a profit had you just held on. But that doesn't mean you should hold on, because on other times the stock will just keep dumping and you're left holding onto a big loss. It can always go lower, so you have to draw the line somewhere. And I completely agree on the last point. Don't follow so-called experts. They know just as much as anyone else, but often less. Let's move on to the next comment. I was around and missed a lot of opportunities. Be realistic in the value that gets created. If housing gets hit, which I think is likely considering the layoffs are already starting, banks will get hammered. Regionals and small banks will get hit the worst, and there will be bad buyouts and failures. But a bank like JP Morgan, they will survive. Goldman will be fine. When names like that drop and look like a bargain, that's when you want in. Recession shows us where the well-run companies are, but it's easy to be profitable in a growth economy. In a recession, look at companies that are still operating profitably. Those are the gems. Those will come out of the recession and skyrocket. Okay, so while it's true that strong companies will survive recessions, it doesn't always mean that their stock price will follow suit. We're moving into investor territory when we talk about company fundamentals and macroeconomics. If you buy into a strong company and you're willing to hold onto it for years, that's fine. But if you're a trader, you have to go to where the action is, regardless of company fundamentals. Next comment. I held value stocks the entire way down in 2008. I lost about half at that low point. It took months to really bottom out. The whole time, the expert media pundits were preaching that deflation would be the new norm. Thankfully, I didn't listen and completely shifted towards commodity-related stocks at the bottom in March 2009, much more aggressive, and made back everything before the year was over. However, that success didn't last more than another year or two. I guess it was luck on my inner contrarian. Then later it wasn't, and I got too complacent thinking I'd hold commodities forever. I beat the mainstream pundits, then got fooled by the gold bug pundits from 2011 to 2015. This is the main reason why I shifted from investing to trading stocks. What you might perceive as good value could fall even further in value. I'd rather be in the strong stocks with strong upward momentum for weeks to months, instead of holding on to what may or may not come back for years. But to each their own. Moving on. 2008 was impossible to trade. Fed bailout was not very transparent, so it was not clear until like 2011 if the remaining financial firms were going to survive or not. This time around, it's not the same yet, but imagine if sales start dropping like 10% in the next few quarters. Stocks can drop like 50% due to the falling sales, revenue, earnings, and PE compression. During boom times, PE expands. What used to be 15 PE becomes something like 25 to 30, and people still continue buying like how it was in Jan-Feb of this year. During bad times, PE falls below 15. Assuming 240 as EPS, 15 PE would lead to 3,600. That's almost 50% drop. Keep in mind, market overshoots on the way down since fear begets fear. Again, I don't really trade on company financials because what could be seen as overvalued can go even higher, and what's perceived as undervalued can go even lower. We see this all the time. That's why I believe that PE ratios are not a good indicator of a stock's future price. I have a simple way of trading. If I see a stock rising on good volume, I want to be part of the ride. If it's the opposite, then I want to avoid it. Next comment. I did not trade during it, but my dad did, and I watched it heavily on TV news as this was around the time I got into investing, buying stocks. Much different than today. 2008, the system almost broke. The system would have broken had it not been for hundreds of billions in government bailouts. People went to prison. People committed suicide. Before the crash, housing was the hottest thing around. Commodities also bubbled up sometime in mid-late 2008. I remember buying gasoline at over $5 a gallon, which was unheard of back then. Once the crash started, everything short soared in value/price. Limited duration longs were crushed. The real economy suffered. Millions became unemployed, and this lasted for years. It was hard to get a job at fast food, let alone a career. Houses lost a tremendous amount of value. Altogether, the short-term drop we have had now is primarily due to uncertainty, in my eyes, as opposed to real structural problems. The crash in 2008 was due to trillions in bad loans with even more in collateralized debt that got into the balance sheets of most of the major investment banks. A few of them, Bear Stearns and Lehman Brothers, did not survive. Others, Merrill Lynch, were absorbed. As far as what worked, cash became king. Deflation. Puts were super expensive. As bad as things seem now, it is nothing like 2008, and I'm hopeful that we never see those conditions again. That's some food for thought. I think many of us are lucky that we didn't have to go through the tough economic situation during those times, though I suppose you could argue that we're still affected by the aftermath of it somewhat. And this comment further reinforces the idea that cash is king during times of extreme uncertainty. And the last comment we have is, Tip 1, you don't trade bear markets. Tip 2, listen to tip 1. I believe there is money to be made in all markets, but as someone who is only profitable in strong markets, I only trade and will probably only trade in strong markets. It just doesn't make any sense for me to trade in bad markets if I can't make any money in mediocre markets. I want to be the hero and make money in this market. Trust me, I want to be the hero so bad and make money. But I'm not going to be a hero. I'm going to be a boring, profitable trader that only trades in good markets. I personally am fully in BIL right now, Treasury Bill Index. It's an index fund where you make around 5% annually. It keeps my account busy and curbs my trading hunger pains. Try this strategy, it freaking works. 5% is nothing, but it's something, and that's the difference. Kulamagi 10-20 markets are good markets. In my opinion, this trader has the right mentality. He or she obviously knows that when the market is in their favor, that's the time to be active. In a bad market, it's all about survival and preparation for the market recovery. I'm assuming he trades when the 10 is above the 20 moving average, just like how Kulamagi, who is a prominent swing trader, how he describes it. Personally, I'd like to see the 10, 20, 50, 200 moving averages above one another. That's when you really get a good sense that the market has indeed recovered and is set to make an extended run. Anyway, that's all the comments that piqued my interest. There were probably a few others that I missed out, so if you want to, you can read the entire thread or even contribute towards them. I've left the links to them below. Good luck to everyone trading or investing in this current market, and as always, if you enjoyed this video, just hit the thumbs up and subscribe to my channel for more swing trading tips. See you in the next video.